Ladies and gentlemen, good day, and welcome to the India Grid Trust Q3 FY23 earnings call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jiten Rishi from Axis Capital. Thank you, and over to you, sir.
Yeah, thank you, Inba. Good evening, ladies and gentlemen. On behalf of Axis Capital, I am pleased to welcome you all for the India Grid Trust Q3 FY23 earnings conference call. We have with us the management team of India Grid Trust, which has been represented by Mr. Harsh Shah, CEO and Whole-Time Director, Ms. Divya Vedi Verma, CFO, Ms. Meghna Pandit, CIO, and Mr. Satish Talmale, COO. We thank the management for giving us this opportunity. We shall begin with the opening remarks from the management, followed by Q&A session. I would like to now hand over the call to the management for opening remarks. Thank you, and over to you, sir. Sir, Harsh, yeah.
Yeah, it looks like Sir's line has just dropped. Ladies and gentlemen, we request you to please remain connected. We'll get Mr. Shah back on the call and Sir's connected. Over to you, sir.
Hi. Good evening, everyone, and thank you for joining the call today. Thank you, Axis team, to host us. And to start with, as we have done, I would like to reiterate our vision on slide number 3. What we had set out to become the most admired yield vehicle in Asia, and I think all the decisions that we have taken is to keeping in mind to achieve this vision. And we believe our strategy of focused business model, value accretive growth, predictable distribution, and optimal cap structure has contributed significantly on this vision over the last 5 years. We continue to strive to live up to that. Now, coming to the quarter, slide 5, where I'll have a quarterly update regarding the highlights of the quarter. In this quarter particularly, it was an action-heavy quarter with 2-3 acquisitions of different types getting signed. At one point, we have signed around 1,500 crores of acquisition of KTL from Sterlite Power, which was part of a framework asset. On the other side, we have signed a framework agreement with GR Infra Limited for around 5,000 crores of assets, where we'll look to bid and eventually monetize the assets of IndiGrid.
Sorry to interrupt, Mr. Shah. We are unable to hear you very clearly. If you can just switch to handset mode and speak, probably we'll be able to hear you.
Sure. Okay. So is that better?
Yes, sir. Thank you very much.
Great. So the GR Infra one, where I was talking about, we did a 5,000 crore framework where we'll bid for certain assets together, and we also signed a term sheet and framework agreement for specific asset, Rajgarh Transmission, with GR Infra. And in the same quarter, we concluded the acquisition of Raichur Sholapur Transmission Company Limited from 3 developers. So we see this quarter as a very successful quarter with respect to the business acquisition. On the other side, on the financial performance, we have continued our robust performance where our EBITDA and revenue both grew by 4% year on year. Collections have remained at 100% this quarter. And DPU increase versus last year versus this year, we are at a 3.5% growth, which we are confident to deliver this year, and will pay the 3.3 rupees DPU this quarter. Net debt to AUM remains at 58%. This is pre-acquisition of KTL, but significantly below the 70% leverage cap as per SEBI, which provides us ability to grow without dilution. On the operating performance side, our average availability remained 99.76, which is what provides us maximum incentives. Proud to achieve 2 million safe man-hours achieved and still going on. On the BI platform which we have developed, which is utilizing the earlier digital investment, that is yielding a lot of results in terms of ability to optimize the cost and I would say use even drone technologies to ensure that our long-term O&M cost remains lower. So that's the quarter three highlights as a performance. On the next slide, slide number 6 is about the industry update. And in general, the power sector remains strong and it is one of the good high-frequency indicator of economic activity. And in general, the demand growth has increased and has continued to increase. And to be honest, demand growth has surpassed the economy and what historically people have predicted. So we do feel confident that the demand growth in India on electricity side will continue to grow on account of variety of short-term and long-term measures. And short-term may be linked to the economic activity, but the longer run, like EVification of transport, might add a substantially big boost in years to come. On the transmission side, again, CA recently released a report which showcases about 250,000 crores of capex required to modernize and set up the country for 500 gigawatt of RE capacity and achieving energy transition. So all in all, I would say that in general, the transmission network in India, we believe that is going to expand substantially on account of the general load growth, second India's efforts towards energy transition. So we believe with that there is going to be substantial amount of capex and we will have a reasonable amount of business out of that. With that outlook on quarter and the year, I would hand over the mic to my colleague Satish Talmale, who is Chief Operating Officer, to take it to the operating performance of IndiGrid for the quarter.
Yeah. Thank you, Ash. Hi, everyone. Good afternoon. Happy to share quarter three operational performance for IndiGrid portfolio of the assets. So again, we focused our objective on zero harm on EHS perspective. For the quarter, we had no major incident, no fatality, zero LTI, zero MTC, medical treatment cases, and zero first aid cases. As Harsh mentioned, we are really proud to achieve 2-mile safe maneuver milestone, and we will strive to continue that performance every quarter. On transmission availability performance, we have achieved portfolio-wide 99.76% availability. Typically, quarter three and quarter four are the quarters for performing all the annual shutdown activities. As you can see on the right-hand side, there are few assets where it is slightly below 99.75. That is attributable to the plant shutdown outages, which we have undertaken to improve the reliability of the asset. And majority of the assets are on the track to achieve 99.75% target availability. On reliability, this quarter was one of the record quarter for us in IndiGrid history. We achieved 0.08 trips per line, which is, I think, best in industry at a peer comparison level. And this is all due to all the hard work which ground teams are putting to make sure the assets are reliable and there are no defects in the system. Digital asset management, as we updated previous quarter, all the assets on the portfolio are operating via DigiGrid platform. And now we are working on advanced analytics, which will help us to make better fact-based decisions to improve the performance on reliability, safety, as well as on the cost optimization. Happy to share that we completed our 2 solarization project at Bhopal and Dhule substation. Idea was to achieve net zero auxiliary power consumption via renewable energy sources so that we achieve our net zero objectives, which is part of our ESG framework. Again, as far as the ESG framework is concerned, biodiversity is a major initiative which we have undertaken, and already action planning study has been initiated for all the critical portfolio assets. On the left-hand side chart, again, the focus on training continued in the quarter. As I said, there were no lost time incidents in the quarter. Unsafe condition reporting, there is a focus so that there is a culture to report all the unsafe conditions at sites. Near miss is something which helps us to prevent any future accident. So that is also being continuously reported. Our solar utility, 100 megawatt power plant, has generated 46.32 million units for the quarter with a performance of 21.97% CUF with availability of 99.41%. And it is one of the best performing plant in the entire solar park. So we are trying to achieve our consistent track record to maintain superior availability. With that, I will hand over to Divya.
Thank you, Satish. Good evening, everyone. We are on slide number 8. Good quarter with a stable performance as compared to the previous quarter, previous year. We have clocked in a revenue of 590 crores with a 4% growth, EBITDA at 536 crores. NDCF generated for the quarter is 294 crores. And we are, as per our guidance, committed and our board have approved the distribution of 3 rupees 30 paisa per unit. Collections for the quarter were good at 100%. We collected 100% of the revenue, and although for the previous year, similar quarter, the collection percentage was at 103%. But collections have improved over previous quarter. In quarter 2, we were at 96% of the collection. DSO days stands at 63 days as on December 22. And that's a month-on-month collection efficiency. For October, November, December, we have seen a good progress resulting to 100% collection for the quarter. Coming on the next slide, number 9, DPU is 3 rupees 30 paisa. It would be distributed in form of interest and capital repayment. Interest is 2 rupees 80 paisa, and capital repayment is approximately 50 paisa. The outstanding units as end of the quarter is around 70 crores, and the gross distribution to all the unit holders at 3 rupees 30 paisa is coming to 231 crores. Record date for the distribution is 31st January, and tentative date by which the unit holder will receive the distribution is 9th of February. NAV as on December stood at 133 rupees. Post this quarter distribution, IndiGrid would have distributed 68 rupees 41 paisa per unit with a total distribution of around 3,646 crores distribution. On the right-hand side, we showcase the trend of distribution year-on-year basis, which is stable and a scalable growth of 3 to 4% year-on-year basis. We are on track to meet this year annual guidance of 13 rupees 20 paisa per unit. Coming on the next slide, 10, which showcase a waterfall from our EBITDA to the NDCF generation. At an SPV level, we had a consolidated EBITDA of 530 crores, net of the finance cost, working capital movement, capex, taxes at SPV. NDCF generated at SPV comes to around 543 crores. Again, net of the trust level expenses, interest cost, and tax, we have generated NDCF of 294 crores, which is well above our guidance requirement, which will be distributing 231 crores. And this quarter, again, we are replenishing reserves. So this gives us an upside of 63 crores of reserve. With this, the total reserve end of the quarter 3 at a console trust level is around 217 crores. So that's all. I hand over to Meghna to take the subsequent slides.
Thanks, Divya. Good evening, everyone. I'm on slide number 11, giving a snapshot of the balance sheet as on 31st of December. We remain regulated by the 3 rating agencies, and our average cost of debt portfolio continues to be at around 7.5%. We ended the quarter with a cash balance of about 1,039 crores, which includes the distribution for this quarter and gesture and balance cash. The mix between the fixed rate borrowings and rate borrowings across a total gross borrowing of 13,000 odd crores continues to be tilted towards the fixed rate of more than 3/4 of the book. Net debt to AUM as on 31st December continues to be at around 58%, leaving a significant headroom for acquisition. Interest coverage ratio remains at a healthy over 2.2 times. The incremental cost of debt in line with the interest rate cycle in the market for this quarter was slightly higher at around 7.8% for the third quarter. But on the right-hand side provides a mix of the sources of borrowing, which today stands on the bank loan side about 60-odd%, the NCD is about 40%. NCD is being subscribed by various investors of mutual funds, corporates, retail HNIs, insurance companies, and the banks also between private banks and PSU banks, right? The bottom chart provides the repayment refinancing schedule of the loan book over the next 10-15 years. And as you can see that broadly not more than 10 to 12% of the overall loan book comes up for repayment slash refinancing in a particular year, ensuring that we are not going with a bunched up of any debt maturity coming up in a single year. Moving on to slide number 12 on the total return chart. As on 31st of December, we continue to provide superior risk-adjusted returns, annualized return being about 14% and total return of 105. Breakup of the total returns between this and price change of 65 and 40%. This doesn't include the third quarter distribution. On the risk basis, again, beta continued to remain very close to zero, and both on the debt side as well as on the equity side, we have continued to outperform various indices and infra stocks. Just to spend a couple of minutes on the next slide, slide number 13, on the framework agreement with GR Infra. This is an agreement to acquire Rajgarh Transmission Limited, which GR Infra won. This is a interstate transmission tariff-based competitively bid transmission project. This is based in for the establishment of Pachora SEZ and a substation of 400 transmission line as well. The scheduled COD for this project is expected to be by December 23. It again is on a boom basis, awarded on a boom basis. The payment will be under the interstate transmission POC mechanism by CTU. The levelized tariff for this project is about 41 crores with a TSA tenure of 35 years. IndiGrid will be acquiring this project upon its COD in the third quarter of next fiscal. In addition to this, we have also signed an MOU with GR Infra to jointly bid up to 5,000 crore of various transmission projects which are coming up. This is a jointly bid identified transmission project. Idea is both GR as well as IndiGrid will be working jointly on these bids, and IGT will be acquiring these projects from GR Infra. Going to slide number 14, this is we signed a binding share purchase agreement with Sterlite Power for acquisition of Khargone transmission project. This is one of the framework assets that we are acquiring. And this constitutes of three generating elements, again an interstate transmission project, part of the POC mechanism with CTU, and boom project with 35 years. The balance life remaining for this project is about 2 years. This has become operational and revenue generating since December 2021. The levelized tariff being about 159 odd crores. Size of the project from an acquisition perspective is close to about 1,500 crores, and likely to add about 85 odd crores to the net distributable cash flow for IndiGrid on a yearly basis. Post acquisition of this project, the AUM for IndiGrid will increase to about 22,700 odd crores, and completely fits in IndiGrid's strategy of acquiring value accretive assets. Unique feature about this asset again is there is a existing synergy with one of our existing 765 kV networks in Bhopal-Dhule transmission project. So one transmission terminates in the Dhule substation, by which we are able to optimize on the operations and maintenance for Khargone transmission post its acquisition. I will just request Harsh to take the next couple of slides on the business outlook over the next few quarters, please.
Thanks, Meghna. I think on slide number 15, we've tried to capture a historical track record and what might happen in future. And I think some of you might have been investors since IPO or even have been present around that. So we had showed this chart at that time 5 years ago to showcase how the DPU chart would look like if there were only IPO assets, which is IPA assets as mentioned above. Then there was a set of assets which we targeted to acquire, which is in the dark blue acquisitions number 1. We acquired other 2 big asset acquisitions in 2019, which was ENICL, OGPTL, and NRSS, that is the green. And subsequently, we have been continuously doing that. Now, what this chart showcased is that the way InvITs and the yield can actually deliver predictability and predictable growth is by acquiring assets consistently at the right price and right growth, which would enable us to not only streamline our DPU predictability, but also increase it over a period of time. And that's why this chart is showcased, because it is to showcase, if you look at from FY23 and behind, it is the value accretive growth that has panned out, and year on year we've increased by 3 to 4%. And as we stand today in FY23, we not only have headroom to maintain what we are distributing for a long time, but also ability to grow by acquisitions as well as the acquisitions that we have done till now. Going on slide 16 is the business outlook for us for the rest of the year and a few months. So on the portfolio strategy, I think we would remain to continue to maintain our assets well and ensure that what we have committed and promised gets delivered as a sustainable distribution to our investors. This year, we would look to deliver the DPU guidance of 13.2, 9 months of which we've already done. We'll continue to acquire assets. We have, in all, acquired about or signed to acquire about 2,000 crore over last quarter. And the future outlay that we see in the transmission sector, about 2.5 lakh crore, is a sizable opportunity. In addition, as and when the state assets become monetizable, we believe that's going to be a large-scale expansion as well. We are also proactively looking for other power transmission bids as well as adjacent spaces like utility-scale battery storage, which do provide sustainable cash flows. The balance sheet side, I think, as we have maintained before, we like to remain in the mean. And when interest rates were falling too fast, we didn't fall too fast. And when interest rates were rising too much, our cost of debt at a portfolio average level, it's going to pretty much remain lesser than the growth that has taken place in the interest rate. So we try to remain in the mean to ensure that there is less variability in terms of our interest rate and cost, and we can provide predictable distribution. On the asset management side, we'll continue to maintain maximum availability in our incentives. In a lot of our portfolio, we have done self-reliant O&M practices, which pretty much means that there is no contractor, no MC. Our own team members at IndiGrid are maintaining those assets. In addition to, we are looking at more business intelligence platform, which will further allow us to optimize the cost and increase reliability. We commit to and try to maintain the world-class EHS and ESG practices across our portfolio. On the next point, while many of them are linked, especially the first two, is with respect to certain amendments in the tax anomalies that we are seeing between InvIT taxation and others. I think it's, let's hope what the budget throws, but if this is something which we do believe that will result into more liquidity and better liquidity for investors and InvITs and REITs, and therefore attract more capital. I think that's where we kind of end the short presentation for the quarter. We can please open for question answer.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Any participant who has a question may enter star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Mohit Kumar from DAM Capital. Please go ahead.
Hi, good evening, sir. So first question is on this framework agreement. So have you identified the projects, and are the projects going to bid out in next 3 months, or is it a slightly longer term in nature?
Yes, we have identified the projects. There are specific projects that we are working on. I think the bid timelines are too specific, but they are the ones which are already announced by the NCT. So it will be one of those projects.
Secondly, sir, what would be the leverage post all these transactions, all the acquisitions, especially once you finish the KTL, and how much extra limit we have to to borrow and acquire the asset? And are we looking to raise the capital in FY24?
Yeah. So Mohit, I think that's maths I can run and hazard a guess, but I think if you add in our AUM and debt, the 1,700 crore will be adding between Raichur and this, it will give that number. But Meghna, do you have the specific number handy which we can share?
Yeah. So Mohit, today we are at 58%, which is after Raichur. After acquiring Khargone Transmission, it will go to somewhere between 66, close to 61 odd %. And that's the identified asset. After that, post acquisition, of course, we will add it both depending on the size of the acquisition. It will get added to the debt as well as to the bottom line. But even after acquiring Khargone, as you can see, there is still significant headroom that is available to us.
So last question, sir. What is holding up the monetization of the Power Grid asset? And is there any thinking to bid the assets out? Is there something you heard of? Yeah.
So I don't know about the hearsay part, but I think, see, whether Power Grid monetizes or not, those assets which are with Power Grid is to be honest. I would say from investment manager of an any perspective, I would say that any public asset monetization, sale of asset or concession, should go through a competitive bidding process, and that will be the right thing to do, because at the end of the day, the assets are built with taxpayers' money. And it's important that a right, transparent bid process takes place for any monetization, be it Power Grid or others. So I think that's our view is whether Power Grid decides to monetize or not. Obviously, it's a listed company with a separate board. It's their choice and decision. But I would rather say even state monetization. If you look at the OMT guidelines, they are very, very clearly identifying that it should be an auction. And I hope that states come up with that process very soon, because that's where most amount of capital is also needed.
Right. Okay, so thank you, sir. Thank you for the answer. Thank you.
Thank you. Our next question is from the line of Rahul Marathe from ICICI Prudential Pension Funds. Please go ahead.
Thank you, sir, for the opportunity. So, if you would like to take me through this MOU that you have signed with GR Infra, so just wanted to get some clarity, like, are there any kind of greenfield risk that we would be exposing ourselves to in this joint bidding? Yeah.
Yeah, thanks. So I think I would say that the two MOU is more like an alignment, right? There are different projects under that. And I would say that in the framework that we have signed for Rajgarh Transmission, we are not taking any greenfield risk, but projects where we may have synergies with, like, let's say an expansion or a connecting bay with our own substation or a small line. We don't mind taking that risk. We've already taken it in Kalam, and that's going well. So, but it is both parties will need to agree to a particular project, and what is at the end of the day, what is the maximum value that both parties bring to table? That's what one evaluates to win in a competitive process. So such MOU allows us to talk freely and, explore different options. And one of the options can be that in a projects where IndiGrid feels there is more synergy value for IndiGrid, we might take under construction risk as well.
So what would be the total exposure of such kind of risk in our total AUM? Like you would have some risk management on that framework.
So I would say, look, we might have risk management framework, but that's not public and we can't make it. But there is a clear guideline of SEBI that we will never be more than 10%. So that is like a law for us, right? We can not be, and we would not like to be even closer to that number. But what exactly we do within which percentage is more a risk management framework at a management level.
Okay. Yeah. Thank you.
Thank you.
Thank you. Our next question is from the line of Pratik Kothari from Unique Portfolio Managers. Please go ahead.
Hi, good evening, and congratulations for a couple of potential acquisitions after a long time. And highly appreciate you sharing the indicative DPU chart. Harsh, my first question regarding this MOU again. This seems to be a very interesting opportunity for us. I mean, the method to go forward. If we just highlight any risks that we need to be aware of while you get into such agreements, or what are you cognizant of?
So the MOU itself doesn't pose any risk, right? As I said, MOU is a memorandum of understanding. So we are working with a common understanding for certain set of projects. That itself will never pose a risk. But as I said, we will look to do different type of arrangements for bids which are more strategic or more lucrative to IndiGrid. So there may be an under construction project which may undertake, but then it only decided by many other parameters, right? So that risk on today is not there. We may take it, but that will be considering if we are getting substantial synergies over there.
But in such MOUs, isn't it that in this case, GR Infra would be the developer, and once that is done, IndiGrid takes on. So where does this under construction risk come in?
Okay. So one is what you described as a framework type of assets which we have done before, and that's what we have done for Rajgarh. Right? And when I say under construction risk, for example, right now we have taken Kallam Transmission as a 100% under construction with IndiGrid, right? While it's going well, but there are projects in which we might have synergies and the risks which are not suitable for IndiGrid. We might partner with somebody, and that could be with GR for one of the projects, right? So it depends on where IndiGrid can add value. In those projects, we might take under construction risks, so as to say that we might bid for it.
Fair, fine. And just one small clarification. We have mentioned this term levelized tariff a couple of times. Can you just explain what does that mean?
So any bid document have a number which gets compared, that whomsoever is the lowest number will be declared a winner, and that number becomes public. So the levelized tariff is that number. We quote for 35 numbers in the model in the bid. To compare with one number, the bid process coordinator may use a discount rate. It can be 10%, 12% different, depending on what they have explicitly stated in the bid. So, and that gets discounted and called the levelized tariff. Then they announce that this bidder has won this project at this levelized tariff. And there's a public announcement. So that is the number that this levelized tariff is referring to.
And is it fair on our part to compare what you're paying for this asset versus the levelized tariff for that underlying asset?
Not for capex, yeah. There are two anomalies in that, because levelized tariff will change depending on what bid processor coordinator took the discount rate, right, which can be substantially different than the other. So the mathematics may not play out very well. And second is, we don't pay for capex, we pay for acquisition value. So if, and again, most of our assets have a tariff curve publicly available. So you can use a particular discount rate and then compare that to the cost of acquisition that we have paid, not capex, cost of acquisition.
Well, thank you and all the best.
Thank you.
Thank you. Our next question is from the line of Chandramouli M, an individual investor. Please go ahead.
So, sir, the 50 paise per unit which you are distributing as a capital repayment, is it a tax free to the unit holder?
Sorry, I could not hear you. Your line was not clear.
Hello.
Chandramouli, if you're on a speaker phone, can you switch to handset and talk, please?
Hello, can you hear me?
You can ask your question. You'll have to repeat your
Hello?
question.
So in the 50 per unit which you are distributing this quarter as a capital repayment, is it tax-free to the unit holder?
Okay, so there is a disclosure on one of our old on the website and exchanges for any tax treatment. I think it is best to refer to that because tax is not our area of expertise that how individuals will get taxed. But we have taken a lot of advice and then tax treatment, potential tax treatments. I think best is to refer to that to check the tax treatment of that.
Okay.
We can tell you we are not in the PDS on that because we are not required to. That's the view from the company.
Okay. Hello. So the next one is, you had mentioned that the new acquisition will add about 85 crores of NDCF from the coming years. That means my understanding is correct, the NDCF will go up by another 8 to 9% from the current level. So is it fair to assume that the distribution per unit will also increase in that rate next year? Hello?
Ladies and gentlemen, it looks like Mr. Harsha's line is disconnected. We request you to please remain connected while we join him back. Please remain connected. We'll get Sir connected back. Ladies and gentlemen, thank you for your patience. We have the line for Mr. Shah connected. And I'm going to unmute the line for Mr. Chandramouli.
Yeah. Hello, sir.
Yes, please.
Yeah. So you had mentioned that the new acquisition will add about 85 crores of NDCF, which means the NDCF will go up by another 8 to 9% from the current level. So can we expect the same kind of incremental, distribution in the coming years?
So I think the reason why we showcased that chart before was exactly that what can be done. However, whether the distribution is increased or not, we have historically taken a decision in the Q4 board meeting for the next annual year. So we will be able to guide on that only in the next quarter. However, if you look at last 5 years track record, we have consistently done it. We apply 2 parameters. One parameter is that when we increase distribution, we want to increase it in a way that at least for next 5-6 years, even if we don't acquire anything, our distribution still remains at that level, right? And that is very important for our business model because we may not acquire assets in some years. We may not acquire assets every quarter. And our business should still provide enough headway to provide distribution visibility to investors and us timing that when the market is right for acquisition, we acquire at the right price. So we keep that flexibility there, but we compare. And whenever there is a ability to increase distribution consistently and it will remain stable for next 5 to 6 years, we look forward to increase that. That has been our strategy in that. And historically, we have done it. Whether it gets done this quarter or not, it's a board's decision and we'll take it up in the next quarter meeting.
Thank you, sir. That's all. Thank you. Thanks for the detail.
Thank you. Before we take the next question, we'd like to remind participants to ask a question. You may enter star and 1. Our next question is from the line of Vishal Doshi, an individual investor. Please go ahead.
Sure, thank you. I have a simple question. Presentation mentions the distribution per unit as % year on year. 1.9 in Q3 FY22 to 3.13 in Q3 FY23. So if you see the breakup on the slide number 9 of the presentation, it shows the distribution per unit 3.19 with a breakup of interest as 3.1137, dividend nil, and capital repayment as 0.18. But if you total to this 3.11 and 0.18, it comes to a total of 3.29 vis-a-vis 3.19. And if you compare it with the payment of quarter 3, which is 3.30, I think there is barely any year-on-year increase in the distribution per unit. So we would request for clarification on the same.
Sorry, if I get your questions right, what you're saying is that because there is capital repayment, there is not enough increase. Is that what you're saying?
Yes, that was my second question. But my first question is that is there any error in the reporting numbers? Like if you see the distribution per unit is 3.19, am I right? However, if you see the slide number 9, it shows that the interest has 3.11 and capital repayment has 0.18. If you total these two items, it becomes 3.29 rather than 3.19.
No. So I think first is that you're looking at quarter 3 FY22. You should have been looking at quarter 3 FY23.
No, so I'm comparing the quarter 3 FY22 versus quarter 3 FY23. So suppose if my quarter 3 FY22 is not 3.19, if it is 3.29, if I compare it with 3.30, there is no 3.5% year-on-year increase in the distribution per unit.
But quarter 3, you are saying quarter 3 FY22 3.19, you're comparing with what number? Sorry, I'm...
3.3, quarter 3 FY23.
Correct. So 3.2 versus 3.3 is about 3.5% increase. Is that right?
Yeah, but that 3.2 is exactly 3.29. So is it possible for someone in the office to maybe open up the presentation and make...
Certainly. No, I can look at it. So you're saying that 3.11 plus 0.1863.
That itself is 3.29.
Understood. So I can tell you that there seems to be an error here. 3.19 is sacrosanct because that's what we distributed as total.
But if you total these two items, then it is 3.29.
I understand. And that's what I'm saying. There seems to be an error in FY22 disclosure of 3.11 and 0.1863. Give us a minute. We have Divya with us. She'll just check in a second.
So obviously, you have correctly inferred my second question. There is a rise in the capital repayment. So I just wanted to understand, although we understand that there is some sort of an EMI schedule where the loan gets repaid, your interest component gets decreases. Although you are still maintaining the maybe same level of the distribution per unit, but in terms of the interest, just wanted to pick up your thoughts. Is there a possibility to have the higher interest income and maybe in a similar fashion, if you at the same time you want to have the objective of maintaining the constant distribution per unit for next maybe say 3, 4, 5, 6 as we have mentioned in the previous query?
Cool. So I'll just describe that in this there are two conceptual inaccuracies. Point 1, comparing the interest and principal versus an EMI is conceptually not I would say, correct assumption over here because 99% of our assets are permanent assets, right? And the reason why the second is, normally it is not in our choice to decide what interest and principal. The income from InvITs, rather let's say income in the hands of InvIT are kept as a pass-through. And with that, CBDT has required us to act the trust itself as a pass-through vehicle. And therefore, whatever form and manner the SPV can give up the cash to the InvIT, right, is the same manner in which IndiGrid needs to give it back to investors. Right? So now what happens? In some of the SPVs, there is, let's say, there is more EBITDA than the interest that you can charge, right? So the residual EBITDA comes from SPV to InvIT in form of principal repayment. And therefore, the InvIT needs to also provide that as principal repayment to investors. Now, this is not a repayment of your capital. There is no face value over here. This is just the manner in which the money is being transferred to SPV to InvIT and InvIT to the investor. Right? The whole reason to choose the trust as a vehicle was to provide this ability, because in companies you cannot do this to give it to investors, right? You cannot take out the capital repayment to pay to owners of the business. And that is the conceptual change. That's why you've chosen trust. So one clarity that it is not in our hands. It depends on, we have 14, 15 SPVs. Harek SPV, the capital structure is different. Depending on that, they will give up some interest, some dividend, some principal. We just add it up at InvIT, make adjustments and distribute. It's not in our ability to change that, right? So that's one. Second is, conceptually, this is not really capital given. Asset value a day before the principal repayment was also the same. Today is also the same. It is just a mode in which the money is passed to the investor because we have chosen trust as a platform, right? As a government has chosen trust as a legal entity. So I think this is first is we need to check this 3.19 plus that. Certainly we take that view. I think you're right on that. We'll just double check and get back on that. But the second conceptually is that principal repayment is just a mode in which the money is passed on to unit holder, not a conceptual repayment of capital.
Got it. Fair point. If I may allow maybe second question or relating to the same thing. Should I go with the second question? Can I go with the second question, please?
Yes, okay.
Yeah. So I also see that you have actually parked some 63 CR has not been distribution and parking it is reserve. The reserve balance has increased to 217 crores. The cumulative. So I do understand that it will be for some future acquisitions or for some future planning or maybe payout or stability point of view.
Yeah.
When I see the slide number 15 with respect to the same and see the chart, maybe you can just help us in understanding the same. FY24 and 25 onwards, the DPU line is again 13.20. So if you can maybe throw some light, because you have the results of 217 plus in the as highlighted in the previous question that you might have an extra EBITDA because of the acquisitions to the tune of around 85 CR. So how does that actually really pan out, which we are not able to see in the slide number 15 on guideline or the framework for the distribution per unit?
Okay, so a very long analysis, but let me describe what I understood. Then you say yes or no, and then I can answer.
Sure.
Your question is that you are earning X DPU today with a set of assets. If you acquire these assets and earn Y DPU, which is higher than the X, and you might have to increase the DPU, but in the slide number 15, there is a chart. According to them, there is FY24 onwards, DPU is going up or can go up. So how does this tally with each other? Is that the question?
Yeah, and just one missing point was that you have the surplus reserve of 217 CR, which is yet to be distribution.
Correct. Understood. Yep. Got it. So first question, let me answer on surplus. Okay, surplus has many uses. Surplus has a use to stabilize. Surplus has a use to keep liquidity for acquisition. Surplus has a use to, fight against volatility sometimes. So it's a variety of uses for the surplus that we have flexibility to use. We think that this surplus is extremely useful, and we have seen that in two occasions. Right, rather many occasions to be honest. But let's say the first occasion is in the COVID first quarter, right? Well, our business was doing fine. We are confident on our collection. But for that one quarter one of FY21, okay, there was a dip in collection because nobody went to office, right? So what do? So then we could dip into our reserves and pay from that. In quarter 2 or 3 onwards, we recovered and then there was no issue. So it's an important tool for management to be able to provide you predictability. Right? So that's one. It can be used in varieties. So I would not include reserve in this analysis. Okay? What we do is in this analysis, now coming to slide number 15, we calculate that if we don't do anything and we just keep refinancing some of our liabilities and keep on operating the asset as is, with the number of assets that are in our hands, how does the DPU profile look for next 5-10 years, right? Now, if you look at on FY23 where we are given 13.2, so if we don't do anything, the red curve was continuing, right? So if we don't acquire any assets also, 13.2 was fairly robust and ongoing, not an issue. Now we acquired, or rather let's say we're signed to acquire right now, is 3 assets, different point in time. So at some point in time in FY24-25, there is going to be sufficient incremental NDCF that might get generated, which we have to distribute to unit holders. Right? Now, when it happens, how much it happens, within the 10% criteria also SEBI, we need to maintain that. It's a model that we run and we say, okay, if your NDCF is more than, let's say 90% NDCF, you have to distribute. And if we have sufficient cash that we have earned, sometimes we may have to increase DPU, right? But it gets modeled every quarter, post results, post cash, and post NDCF. So this is more for an indication, right, of how if somebody was to model our the entire tariff curve, which are published in valuation reports, someone might reach similar analysis. It's more a guideline. It's not a accurate prediction in which quarter and year the DPU will go up.
Okay, fair point. Thanks for sharing that insights. Thank you. Congratulations once again.
Thank you.
Thank you. Our next question is from the line of Sunil Shah from Total Star. Please go ahead.
Yeah, thank you for the opportunity. Welcome, Harsh. Always good to hear you, Meghna, and everybody on the call. Thank you so much for this call and everything that you share. It's nice to have the slide 15 back in the presentation deck. Now, what I understand is the slide 15 is indicating all the assets which are reasonably in place and which are more or less in the framework side as well, barring the new 3 assets. So the MOU which we are going to sign off, those assets are completely going to be future and is still not at all captured or envisaged in the slide 15. Is my thinking clear on this?
Yes, the thinking is right, and that's what we are not putting anything for which we have not signed agreements or a confirmed bid or things like that. This is based on, the orange line is based on exactly the rights of Kalam and KTL. So.
Yeah, so that's completely visible to us, and so that's what it is, right?
Yeah.
Okay. Yeah. Great. I guess all other questions have been answered by everybody else, and they've asked everything. So thank you so much. We can move on to the next question. Thanks.
Thank you. Our next question is from the line of Rajan Patadia, an individual investor. Please go ahead.
Hello. Hello.
Yeah, we can hear you.
First of all, congratulations. I am individual investor since many years. I would like to congratulate for your yield accretive acquisition. My question is, the acquisition that we are going to do worth 1,500 crores, for which, I have read the valuation report. We are acquiring at around 8.5% ROI, and so what will be our cost of interest for that? Because if there is a little increase in rate of interest, it will not be that much yield accretive. Can you please
Yes.
Can you throw some light on that?
Correct. No, I think it's a very important question and clarification, so it's good to have this question. The 8.5% that you may be referring in the valuation report is WACC, and it is not our rate of interest or cost at which we are buying. What the valuation report does is calculates the WACC, takes the tax of 20% or 25%, whatever is applicable, and reduces the EBITDA of the project to come to the value. So therefore, 8.5%, which is there as a WACC, discounts the cash flow after removing 20% tax from there. Whereas in reality, we don't pay 20% tax. So if one was to calculate what is the rate of interest or the way you are trying to compare, you should just use discount rate to come to the FMV that is there without tax impact, and that number will be higher than 8.5% for FMV calculation. So coming to the interest side, I think agree with your point. So if I were to describe this, is it as a spread at a cost of debt versus at the rate at which you have discounted the cash flows? The spread between them is sizably higher the moment you look at it from an EBITDA discount perspective. So we will have a good amount of spread between our cost of debt and the rate of discounting at which we have purchased. So I don't see it as an impact coming on us substantially. And again, we are using the current cost of debt and capital, which is at I would say, I won't say peak, but at an elevated level of interest rates.
Yeah, definitely not at bottom. Yeah.
Yes, definitely not at bottom. Correct. Yeah. So I think even at this rate, there is sufficient cushion in terms of further variability, and will still be accretive on this acquisition.
And what will be our borrowing capacity left after this acquisition?
I think earlier somebody asked that question. There would be significant. Now, I don't have the exact number, but one can calculate, but anywhere from 2 to 3,000 crores as we reckon. So it's sizable amount.
Thank you. That was the last question for today. I now request the management team to add a few closing comments.
Thank you. And thanks a lot for hosting us, and thanks all the investors to join the call. And we're really happy about the questions that have come to us, very important ones. And I think I also recognized one of the questions which was about an errata and the DPU breakup for FY22. We'll correct that. But other than that, I think very important questions. We are glad that our investors understand our business so well. They understand the values by which we are living, the flexibility, like keeping reserve with us and doing accretive acquisitions. All of it, that courage comes from the fact that our investors understand the business very well, and they do show confidence on how we are running the assets. So thank you. Look forward for the next one.
Thank you. Ladies and gentlemen, on behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.